Will Fitch Ratings downgrading U.S. affect markets in long term? Welcome to Fin Minutes. Fitch Ratings downgraded United States long-term foreign currency issuer default rating to A+ from AAA. Earlier in May, it had kept U.S. rating on negative watch, citing debt ceiling drama. Later, officials negotiated a deal to settle debt ceiling issue, but that uncertainty kept markets on toes. After deal, markets were seeing one-way rally around the world, but this downgrade came as a shock to markets as markets around the world closed in red today. Richard Francis, Fitch's co-head of the Americas Sovereign Ratings, said there is a steady deterioration in U.S. key metrics over the years as, in 2007, general government debt was less than 60% and now it's 113%. So there has been a clear deterioration. Furthermore, we're expecting fiscal deficits to rise over the next 3 years, and we expect debt to continue to rise over the next 3 years. He also cited standoff between Republicans and Democrats on debt ceiling issue that has hindered the U.S. government from coming up with meaningful solutions to deal with growing fiscal issues, on entitlement programs such as Social Security and Medicare. Given the high level of the debt, given the increasing deficits that we're expecting, and given the kind of deterioration in governance and unwillingness to really tackle these issues, we don't think that's consistent with the AAA anymore, Francis said. Fitch believes it is more of a governance issue than economical issue. There's nothing new in what Fitch cited as reason for rating downgrade or increase in debt, but given the strength of economy it doesn't seem too much worrisome, suggested experts. Fitch said they see it as governance issue and differences between Republicans and Democrats on various issues including debt ceiling is something hurting the economic outlook. But in my view, nothing new in this tussle. It is more of a political issue than a governance issue. Experts are of the view that it will put a dent on reputation of country, currency, but it won't deter long-term investors from buying securities. Investors won't sell their stocks looking at Fitch Ratings downgrading U.S. to A+ from AAA. Any sell-off will be temporary and short-lived. Last time S&P downgraded U.S. from its highest AAA to second highest A+. S&P still rates U.S. A+, causing catastrophic effect on markets. Tremors of these sell-off were felt around the world. Fitch in its report believes that financial situation in terms of fiscal deficit for U.S. will keep deteriorating for another 3 years before start improving. It also believes a recession will strike U.S. in fourth quarter of FY24 and first quarter of FY25. Fitch Ratings though may be right in its observation, but a lot of all this is factored in by the market. When Fitch kept U.S. on negative watch in May on the peak of debt ceiling hike uncertainty, general consensus was there of a rating downgrade, so it was not a shock as such. Markets are also well aware of strength in U.S. economy as unemployment is at its lowest level in years and GDP is growing despite macro uncertainties. Thanks for watching.